Yeah, so I'm excited. This leaderboard is a little unusual. We've had the same kind of leaderboard for weeks straight. So here at the top, we've got an ESG ETF, and on the fourth place. I'll get to that in a minute. Also, gold up here is interesting, and small caps. And on the outflows, you do see Qs and SPYs. So I do see a little risk-off action here, maybe some profit taking. But let's just really pay attention to ESG because it's so unusual. Let's look at ESG ETFs and their monthly flows. And I'll show you how wild. Those two ETFs are basically already pushing ESG ETFs to record flows. We still got a couple weeks left. Now, this isn't a bunch of people who read Larry Fink's letter and are rushing in to buy ESG. It's BlackRock itself. After Larry Fink talked about getting more concerned about these kind of issues, they put these funds into their models, which advisors use. So that was instant money into those. Now, let's just say this is good flows, but it's still small time. ESG ETFs only have 20 billion, so they're pretty small. This is low vol in value. So you see ESG is still very small, 0.5% of the assets, and half of it is seed money, prior capital commitments and whatnot. But Scarlet, you can't deny that this is a good month for ESG. It's a big, everybody's talking about it, so it's a good sign. But again, there's still a very underwhelming category.
Right, but big growth rates given a small base. All right, for this week's roundtable, we've got David Perlman, ETF strategist at UBS Global Wealth Management, and Katie Greifeld making her debut on ETF IQ. She's a cross-asset reporter for Bloomberg News. David, let me start with you because, as Eric mentioned, climate change is topic number one these days, certainly at Davos, and it's become a real defining issue. Bloomberg, of course, is all over it with the launch of our new coverage called Bloomberg Green. I want to get your take because we know in the ETF world, there's no shortage of different ETF funds that investors can buy into. What kind of demand do you see from your clients for these products?
Sure. So at UBS, we do expect demand for sustainable solutions to increase over the coming years, just given demographic changes and concerns over the environment. But as Eric pointed out, the adoption in the ETF space has been pretty slow, at least in the U.S. markets. And there are just a number of challenges that I think present a headwind. One of which is that you're dealing with consumer preferences, and there's no consensus as to what should or should not be included in these portfolios. And just the other day, I was asked by an investor for a client, they wanted a carbon-free and bank-free solution, which is really the first time I've ever gotten that mix of requests for a sustainable strategy. So, and ETFs have all these benefits, the wrapper itself, but mass customization, right? It's not one of them, like with any pooled vehicle.
That's a great point. Katie, Eric mentioned how BlackRock's ESG funds have been taking in record amounts of cash. Give us some more context around the big numbers here. Certainly they're impressive.
Right, so BlackRock CEO Larry Fink kicked that all off. He said in his annual letter that climate change could upend global finance and that BlackRock's going to work to address that issue. Part of that includes doubling its sustainable ETF lineup to about 150. And these inflows we've seen this past week, as Eric said, it might be BlackRock just moving around its own money, but it's not just Larry Fink. We heard from the Bank of International Settlements, who warned that green swan events triggered by climate change could set off the next global financial crisis. So it's going to be interesting to see if these inflows persist as, that drumbeat just grows louder.
Dave, you write about ETFs for a large base of financial advisors, and one of your themes is, hey, the U.S. has had a nice run, but let's think about going overseas. And we've heard this all year last year, but international's pretty much lagged. Talk about why you think the time is now to move, and where specifically.
So if you look at the global equity markets, the U.S. equity allocation is about 55%. And most investors in the U.S. hold much higher weightings to the U.S. And we're going on 10 plus years of U.S. equity outperformance. So they've been rewarded for that positioning. But 10 plus years of outperformance, it's rarely sustained. So we think it's a really good time to revisit your allocations to international equities. Right now in our wealth management models, we're overweight emerging market equities, and really for three main reasons. One, it's just cheaper valuations than you're getting in the U.S. Two, we expect faster earnings growth. And three, when you have the trade deal, we expect more of those benefits to accrue to emerging markets than to the developed. So that's why we're tactically overweight EM at this point.
Still, it's a big ask to get people to stay away from SPY, VU, or IVV. Katie, on this idea that the rest of the world is a better bet than the U.S. in 2020, the U.S. dollar, of course, is the big variable, isn't it?
Exactly. And, when I talk to people, I've heard a lot of bullishness for overseas assets, and that's usually coupled with the view that the dollar is going to weaken. And it actually feeds into this really interesting story about currency hedged ETFs. These products have done really well. In a lot of cases, they're outperforming their unhedged benchmarks, but they just haven't been attracting flows. 2019 was the 5th straight year of outflows. And again, they've been working because the dollar has been strengthening and doing well. So, I mean, I've been trying to get a sense of what the outlook is, whether this overseas bullishness is going to create a revival for these sorts of products. But mostly what I'm hearing is it's probably not going to look like the glory days of 2013, 2014.
Those products were rock stars. I mean, it was nothing. It was like a fad. Yeah, I don't see it going back there, but we'll see. Some more outperformance could help. Speaking of fads, low vol was a huge hit last year. Everybody loves it. I love people who come on and challenge the status quo. You think low vol ETFs might not be the best thing for a portfolio now? Why is that?
So it really comes down to what you're looking to protect against. So if your concern is that there's going to be higher volatility and you could lead to some shorter term corrections, then sure, low vol will help to mitigate some of those risks. But if your concern is that there's going to be a severe prolonged downturn, then you could be better off in some other strategy like a trend following equity that tries to get out of equities to avoid some of the most severe drawdowns. So I think it really comes down to what are you trying to protect your portfolio for. It doesn't have to be an all or none decision, right? I mean, the more defensive strategies you have, the better prepared you are because who knows what's going to trigger the next downturn.
Well, speaking of defense, ultra-short duration had its heyday back in the early part of 2018 when the Fed was raising rates. If we get an unwind of the everything rally, these guys could be in favor once again. What else could benefit?
Sure. So if you're dealing with everything selling off, shorter duration, higher quality would stand to benefit in an environment where risk assets just more broadly sell off. I'm sure you could have a scenario where higher quality or treasuries sell off too, but chances are the magnitudes are going to be much less, and you still would have been better off positioning and having some of those safe haven assets in your portfolio.